Greetings, test takers. This is Dean Tenney. I'm coming to you from my studio here in fabulous Las Vegas. I'm always looking at carve out opportunities. What I mean by that is we have longer narrative lectures on the channel. And, I like to, if I can get a 10, 15-minute carve out that's, applicable to more exam, I like to do that. So that's what today is. We're going to be contrasting rights versus warrants. And I'll put this in the SIE playlist. I'll put this in the Series 7 playlist, and I'll put this in the 65 playlist. Spoiler alert, the biggest thing you got to know or be able to do on all those exams is contrast rights versus warrants. How are they different? And so the takeaway, I'll give it up front, probably, you can stick around for the rest of the carve out, but the spoiler alert is that you need to know rights are short-term and exercisable when issued below the current market price. And warrants are long-term and at issuance exercisable above the current market price. Okay, so let's get started. Let's say that Worldwide Widgets has 2 million shares outstanding. And let's say that right now the stock, let me get a smaller font for that. And let's say that right now the current market price of the stock is $54 a share. And let's say that Worldwide Widgets wants to raise $50 million or somewhere around that through the issuance of some more stock. And so what they want to do is they want to issue another 1 million shares. Companies, corporations, remember, capitalization consists of two components, equity and debt. Now, typically an investment banking firm is going to charge anywhere from 7 to 8% to raise additional money. So let's say that it's, 8% is the charge to hire Goldman Sachs or Morgan Stanley to sell this new 1 million shares at 54. So before we go sell this to new folks, our existing shareholders have what's called a preemptive right. And the preemptive right you have as an existing owner is the right not to be diluted. So let's just say that Dean owns 200,000 shares of Worldwide Widgets. And so as you can see here, I'm actually a 10% owner of the corporation. And if that corporation goes to issue that other 1 million shares and I don't buy any, I'm going to own 200,000 of 3 million shares. I'm going to go from being a 10% owner to what, 6.66% owner. And I have a right not to be diluted. And so what this amounts to is that our existing owners, by the way, not just me, every shareholder, what this amounts to is every existing owner has the first right of refusal on the issuance of new shares. And so, my broker calls me and says, hey, Dean, Worldwide Widgets is going to be offering another 1 million shares or issuing another 1 million shares. And the reason I called you is they're doing a rights offering. The rights offering is the mechanism for the existing owners to maintain their proportion ownership. So that's what we're going to be doing here. The corporation Worldwide Widgets is going to do a rights offering. And so my broker calls me and he says, hey, Dean, you own 200,000 shares, and so you have 200,000 rights. So as many shares as you have, that's how many rights you have. So if you had 100 shares, you'd have 100 rights. If you had 1,000 shares, you'd have 1,000 rights. Now, not only do we have to first go to our existing shareholder and ask them for the money, we must do that. They're the most likely candidates to provide us with the additional equity financing anyways, right? Because they're already kind of in the hot water with us. And what the corporation will do is pass on the savings that not having to pay the investment banker to the existing shareholders. In other words, what we're going to let our existing shareholders do is subscribe at less than the current market price. And that too is testable, as I just said, to know that at issuance, the subscription price is going to be less than the market price. So I'll just make up some numbers here. We said the stock is $54 a share. We said Goldman Sachs or Morgan Stanley or UPS or Merrill Lynch is going to charge us typically, 7-8%, let's call it 8% to raise money. And so if we say 8%, if we don't have to pay the investment banker, let's just pass that on to our existing shareholders and let them say, hey, you can buy the stock at 50. What we're doing is passing that savings on to our existing owners. And so my broker says, Dean, do you want to participate? So, I have some decisions to make here. One is I could decide to exercise, and that means I want to maintain my proportionate ownership. Now here, we're not going to have to really figure this out, but think about it. If I have 200,000 shares of 2 million, that's 10%. And they're issuing another 100,000 million shares for a total of 3. That 10% would be taking my shares that I own, 200,000 shares, to 100,000 shares. And so what that means is I'm going to need 2 rights to get an additional share. I don't have a right to get more shares. I have a right to maintain my proportionate ownership. And so 2 rights are needed to get an additional share. So if I want to exercise, what I'm going to do is send my 200,000 rights. It takes 2 rights to get an additional share. So that means I can buy 100,000 shares. I'm going to have to send in the subscription price, which is 50. And so 100 times 1,000 times 50. I give the issuer $5 million. I send that $5 million into the rights or transfer agent, and I will have maintained my proportionate ownership. How did Dean get the 5 million? I have 200,000 rights. It takes 2 rights to get an additional share. So that means I can buy 100,000 shares at 50. That's where I'm coming up with that. Now, one thing that's testable is to know that we can't demand additional capital from our existing owners. We can ask politely, but we can't demand. The shares you have, test question, are non-assessable. And non-assessable means we can ask for this, but we can't do that. Now you say, Dean, do I have to exercise? I say, well, no, but in theory, having a right to buy the stock, by the way, in the real world, something's only worth what someone else is willing to pay. But in theory, having a right to buy the stock at 50 when the stock's at 54 is worth $4 in theory, right? So that's what that's worth in theory, being able to buy that stock at that. Now, it's going to take some money to do that, right? So number of rights needed. What we're trying to figure out here is the theoretical value of a right. Theoretical value, because, as I said before, things are only worth what somebody's willing to pay. Now, right now, there is no secondary market for these rights. There is no secondary market for the rights. Now, right now, the rights are trading cum. That means with the stock. Now, at some point, they'll be trading separately. And so if you're the shareholder, my broker says, well, Dean, if you don't want to do this, we should consider when they start trading X to sell them to someone else. And so right now, the point is they're worth less if you have to buy the stock to participate. Right now, you have to own the stock to participate. I haven't had in many years, anybody tell me they've actually had to, actually calculate this theoretical value. But anyways, in theory, these are worth $1.33 if they're trading cum. Now, at some point, they're going to be trading separately. And so another thing I could decide to do is I could decide to trade these options or trade these rights. And they got good mnemonic is T: trade, exercise, expire. What we mean by expire is nobody's going to do this if it doesn't make any economic sense. So, I've seen rights offerings fall apart because, sometimes the rights are done when the corporation is kind of desperate for financing. If it doesn't come to fruition, it's going to be a problem. But let's say now they're trading X rights. X is Latin for without. I say, do you have an ex-spouse? That means you're no longer trading with your spouse attached, right? So now you can buy these on the secondary market. We would expect they have intrinsic value, right? Being able to buy the stock at 50 when the stock's at 54. Once again, that relationship hasn't changed. That is still worth 4 points or $4. By the way, this is the only one that's always at issuance has intrinsic value or is exercisable below the market. That's not true of warrants. That's not true of convertibles. And one thing they like is the kind of the accept format. And so we would expect these to be trading at something more than the theoretical value because there'd be some time value as well. Whoop. So we're going to divide that. And now we're just going to divide by number of rights needed. Once again, though, I haven't had anybody in a long time tell me that they've had to actually do this. And so we have 4 divided by 2. Now each of these rights are worth $2. They're worth, number of rights needed plus 1 versus X rights. Now you say, hey, well, Dean, what happens if they don't sell the shares? I said, well, sometimes if they don't sell all of these million shares of the existing shareholders, maybe they sell 800,000, maybe that's the end of it. But there is a type of underwriting. Sometimes the rights offering includes this type of underwriting. Sometimes they do not. And a response by my broker might be say, Dean, there's a standby in place. There's a standby in place. And what that means is the issuer, Worldwide Widgets, has paid the investment banking firm to stand by. And it's a type of a firm commitment underwriting, which just means is that the issuer knows that whatever their existing shareholders don't suck up, or the people who buy the rights in the secondary market don't suck up, the investment banking firm will then make sure those shares get distributed. So standby underwritings are used in rights offering to make sure the shares get distributed. Now let's change that color there to give us a different color. Okay, so we've talked about worldwide widgets. We've talked about what can happen in terms of this rights offering. We said the biggest takeaway, I haven't had anybody in a long time tell me they've had to calculate the theory value of a right. But what is very testable, and I kind of gave you the spoiler alert already on this, is to make sure on every exam, you can tell me that you understand that rights are short term. And it kind of makes sense because they need the equity financing and they need it now. And at issuance are exercisable below the current market price. That's the biggest takeaway in terms of a test issue, right? Let's just label this number 1. And let's label this number 2. Okay, so the other thing I want to do in this little carve out is talk about, as I said, the distinction between rights and warrants, because that's the big test question is, can you contrast rights versus warrants, rights versus warrants? So let's clear our whiteboard. And I'll play broker this time. You play customer. And I call you up and say, are you familiar with units? Are you familiar with units? And you say, well, no, Dean, I'm not familiar with a unit. I say, well, a unit is more than one security offered together. More than one security offered together. So I'm going to offer you more than one security, a bundle, if you will. A bundle. A bundle means there's more than one thing in here. More than one security offered together. Now, typically, the units can consist of either preferred stock and bonds. And so I'm the broker, you're the customer. And I say, hey, listen, the reason I've called you is this biotech fund company is raising some additional financing through the issuance of debt. And so what I'd like you to do is buy $100,000 worth of their debentures, $100,000 worth of their debentures. Let me put that up there. These are 100 and just means 100 bonds. These are 6% bonds. So if you lend the issuer, this biotech company, this $100,000 on January 1 and July 1, they're going to pay you 6% is $60 bond. You got 100 of them, so they're going to pay you $6,000 annually, $3,000 on July 1st, and $3,000 on January 1st, J&J. And 10 years to maturity. And you say, well, Dean, that doesn't seem like a very high interest rate. I mean, brand new bonds I'm looking at pay 8 or 9. What's the credit quality? I said, well, the credit quality is not that good. I mean, the company's in their early life stages, so the bonds are not rated. And you say, gee, Steve, not rated? I'm going to lend them $100,000 with the potential of default. I said, well, yeah. I said, but the biotech company we think could be the next Amgen, Genentech. These are biotech companies that, made tens of billions of dollars for their shareholders. And we think right now that it's an acorn, but we think it could become an oak tree. Not every acorn becomes an oak tree, but some do. And you go, well, gee whiz, so what? I get everything goes according to plan, and I get my $100,000 back. I go, well, I agree with you. If that's all I had for you today, I too might take a pass, but I have a sweetener. Sweeteners get people to buy things they might not otherwise buy. And so you say, well, Dean, what's the sweetener? I said, well, let me share the sweetener with you. Right now, the current market price of the stock is 6. And for the next 10 years, we're going to give you some warrants. And again, let me just put that in black. We said that the biggest takeaway of this little carve out is to know that warrants are long-term and exercisable above the current market price. We said that's a big, it looks like Dean's got a typo there. Okay, so I say the sweetener is we're going to let you buy the strike price, if you will. We're going to let you buy the stock for the next 10 years. Wow, we're going to let you buy the stock for the next 10 years. Let me get a smaller font. For $7. And you said, well, Dean, right now that makes no sense. I go, well, right now that makes no sense. But, it might make some sense at some future date. So, these warrants, we're using the warrants as a sweetener to get you to buy the bonds. By the way, since that's an advantage, now you might be willing to pay a lower coupon or accept a lower coupon or interest rate, right? That's why it's going to pay less. And that's the point from the issuer standpoint. The issuer standpoints is that they get to use this as a potential way to lower their cost of funds. By the way, as well as have the ability to raise equity financing down the road, right? So again, these can be traded separately, whatever the case may be. And so, I would tell you how many warrants you have. For example, in 2010, Warren Buffett, Berkshire Hathaway provided $5 billion in financing to Bank of America. And as part of that financing, Berkshire Hathaway said, we'd like a sweetener. We'd like warrants. We'd like warrants to buy a Bank of America stock for $7.14. That was what the warrants were exercisable about. That's the exercise price of the warrants. And at the time the warrants were issued, 2010, Bank of America Common was trading at 6. And so right now, that at the time these warrants were issued, that made no sense. But in 2015, by the way, the Bank of America gave Berkshire Hathaway $700 million in warrants. So they have the ability to buy 700 million shares of B of A at $7.14. And as we said, what Berkshire Hathaway can do, we said a good way to remember this is T. They can trade these warrants, they can exercise, or they can let them expire. Now, they're not going to let them expire if the Bank of America stock, what we're hoping is right. Bank of America took the $5 billion worth of financing and build the business. And now let's say Bank of America, the current market price now, 2015 is 5 years later. And at the time, the Bank of America stock is now 25. So now that makes a lot of sense, right? And so Bank of America did indeed, or excuse me, Berkshire Hathaway did exercise these warrants. And so they exercised the warrants. I'm just getting my calculator, 700 million times $7.14. That means they provided Bank of America with another additional 5 billion, close 4,998,000. Let's just call it 5 billion. But when they exercise, that provides additional equity financing to the issuer. I just posted in social media an example of this. And so this is 4,998. I'm oversimplifying this. Actually, they agreed to round it up. So but I think I did that math correctly. All right. Well, anyways, again, the biggest part of this lecture, this little carve out, is to recognize and be able on the test, whether it's a SIE, a 7 or a 65. I went a little more in depth than is required. The biggest thing, as we said, is can you contrast rights, which are short term and at issuance exercise below the current market price, with warrants, which are long term and at issuance exercisable above the current market price. By the way, remember, it's kind of like an option. It's a derivative, but unlike the option, remember, there's no equity financing provided if somebody exercises an Apple call. There is equity financing if people exercise their rights or exercise their warrants, right? And both the exercise of the rights and warrants, and even convertibles for that matter, have potential dilution to the existing shareholders. And we said that's the point of that rights offering. Okay, so just remember that inch by inch, your test is a cinch. Yard by yard, your test is hard. And I'll see you for our next installment, whenever that may be.